far as strategies for your portfolio is concerned. I am joined by Rakshit Ranjan of Marcellus Investment Managers. Rakshit, hi, afternoon, and welcome to the show. Let's begin with the market trajectory. So the current year so far has been very volatile with a lot of unexpected events. We started off with the trade tariff thing, which, got died down. Then we had the geopolitical tension, Operation Sindoor, then the international or the other macros were not favoring our markets. And there was a phase where the market was still directionless, but then again now, as far as the red flags are concerned from on the geopolitical front have died down. There is a relief, okay? But what sense are you making out of the current market juncture in terms of market caps? How are you looking at the large caps versus the broader indices?
Sure. Good afternoon. So to begin with, I think it's very difficult to answer that question with a short-term perspective. There will always be events with difficult to predict correlations with fundamentals basis the event or share price movements basis the fundamentals and the event. So I don't think we have an answer to this question from a short-term perspective. From a very long-term perspective, I think the economy on the whole is on a very solid footing, whether it be in terms of the demographics, the consumption side, the investment side, capex side, from a long-term standpoint. Having said that, I think over the medium term for the broader market, there are a few risks that investors should be aware of. Risk number one is earnings growth, profit growth for broader indices. It tends to be very cyclical over long periods of time, and it's coming off a cyclical high phase. FY21 to 24 Nifty 50 earnings growth was in the mid-20s CAGR, and that's a very high run rate. We've already seen a significant moderation in FY25, where it was mid to high single digits at best earnings growth for Nifty. So there's a risk that we might be entering a bit of a mean reversion after a cyclically high phase of earnings growth from a medium-term perspective. There's also a risk around valuations for the broader market at about 20-22 times one-year forward earnings for Nifty 50. It's again a cyclical high there. So combine these two, I think as long as investors manage to stay away from these kinds of risks or downside potentials, the long-term outlook remains solid. And we at Marcellus are very much bottom-up stock pickers, benefiting from such an environment because quality delivers when tailwinds go away for the broader economy in an outside manner.
Rakshit, hi, Ankur this side. While everybody is waiting for 9th July, the deadline when tariffs will start, whether or not negotiations happen with different countries, you have mentioned that insulation from geopolitical risks, the kind of portfolio you have maintained where less exposure is there. I want to know which are these sectors or stocks you have focused on where a limited impact will be there?
Sure. So, our sectoral orientations at the moment in the portfolio include healthcare as a broader theme, which includes hospitals, diagnostics, health insurance plays, a little bit of pharma. Here, we don't see connections with geopolitical events in a meaningful way. Secondly, there are pockets of discretionary consumption which are benefiting from unorganized to organized shifts, which are also at the cusp of market share consolidation for the dominant or for the better quality players. And in the last 5-6 years, there have also been shifts in wallet shares for consumers, for households, in terms of categories. These are all sort of broader macro themes, if I were to call them, which are not exposed to the geopolitical risks. And in that respect, yes, you're right. Bulk of our portfolio is not waiting for 9th of July.
All right, so Rakshit, now in terms of the risk-reward ratio, even in your portfolios, how are you trying to mitigate the risk factor? I'm asking also because a lot of experts are looking at time correction in the broader market, specifically in the mid-cap and small-cap. But we've been seeing broader markets outperform since quite a few sessions. But over here, we're talking about a long-term portfolio. Okay, are you also waiting for a time correction? You think the extra fraud that has gone now, but then there are certain pockets where we are looking at time correction. And also, I want to know your expectation on the first quarter results now.
Sure. So, first and foremost, before we come to valuations, what we want in the portfolio is classical quality attributes coming up in a bottom-up stock picking approach. Now, the classical quality attributes are moats, competitive advantages, capital allocation, which is in a way reinvestment of cash generated due to high quality moats, and all of this being driven by a high quality management team. This approach to quality becomes even more important when in the external environment tailwinds are not as strong, right? Because then it's not a broad based market. It's a very narrow winner takes all kind of an approach. So that's the first piece. When it comes to valuations, we are not waiting for dips. We are fully invested in consistent compounders because we are hunting for two types of plays on valuation grounds. First and foremost, areas where quality is yet to be discovered, right? And there are a few such companies in certain sectors where either because over the last 3-4 years we had a far more broad-based rally, quality wasn't adequately appreciated in the valuations, or there might be a new disruptive sort of high quality business emerging where the quality of the business is yet to be appreciated. So that's one area. Unfortunately, that's not a wide enough playground for us from where we
Again,
could have.
I'm sorry for the interruption due to paucity of time. I have to do that. But thank you so much for joining at this hour.